What happened to Bitcoin's promise of democratizing money? Some say it has turned into digital gold, being speculated on crypto exchanges. However, for some, digital gold is their only way to store wealth, as their native currency has lost all credibility for wealth creation. It hasn't turned out to be e-money as it originally planned out to be, but it was the first step for people to think about financial services outside of the traditional banking system. This is where decentralized finance comes in, DeFi as they call it. It is paving the way for a future of finance outside of the realm of traditional banking systems. Hi, my name is Takatoshi Shibayama, CEO of Blockchain Singapore and the host of Future Design Podcast. I spent 18 years in global investment banks, working for companies like JP Morgan and Goldman Sachs. I also worked as an analyst for a $30 billion hedge fund, and I co-founded a $1 billion value-focused hedge fund. So I think I know a thing or two about finance. Today I'll be introducing you to the concept of DeFi, where it has picked up where Bitcoin left off. Bitcoin is blockchain 1.0. Its system is perfect as acting as digital gold, transacting on crypto exchanges. However, its capacity is limited to drive financial services further. Ethereum, on the other hand, despite its limitations, is considered blockchain 2.0. As a highly flexible platform where developers can make many different applications on top of it. The chairman of Commodities Futures Trading Commission has said, "Let me just say how impressed I am with Ethereum. If Bitcoin is email, a one-trick pony so to speak, but obviously revolutionary, the whole idea of DeFi, I think at the end of the day, it could lead to a massive disintermediation of the financial system and traditional players. For finance, Blockchain 1.0 was great for money remittances, digital money, and Blockchain 2.0 has enabled for tokenization of securitized assets, reorganization of systems and infrastructure, automating of contract payments, digital identity, and enabling new forms of financial contract, assets, and forms of financing." Before we had to bunk down into our houses earlier this year, DeFi was starting to become a thing, but certainly not the popularity it has now. The most impactful DeFi projects were stablecoins. Tether was one of them, and then came many of the crypto exchanges' versions of them. Collateral-based stablecoins are very easy to understand. Basically, they are backed by the USD, gold, or some other form of asset. However, they are also tied to the underlying assets that are centralized, thus not making them completely decentralized. Then there are algorithmic ones like MakerDAO's DAI. DAI is like a form of collateralized loan against a deposit of Ethereum's ETH. If one deposits a market value of ETH, Maker will issue DAI according to its loan-to-value ratio. Let's say they will issue 2/3 of that value and collateralize the remaining third as a buffer for protection. For example, you have $1,500 worth of ETH and you send it to Maker. It will issue $1,000 of DAI. If the value of ETH rises to $2,000, there will be an over-collateralization of $667. Therefore, it will have an extra $333 of loan capacity. In reverse, if the ETH devalues to $900, a liquidation event occurs, and you return the loan with your DAI with an extra $100. The monetary policy works completely on supply and demand. If the prices of ETH goes up, the supply of DAI will go up, thus decreasing the price of DAI to its target price. And vice versa is the same as well. If the prices of ETH goes down, the supply will go down, and the prices of DAI will go up, hitting its target price. It's completely based on behavioral economics. All these risk management and logistics will be governed by the holders of MKR tokens, which is the utility token for Maker. The holders of these tokens by the continuous approval voting system, can vote or submit a proposal that will implement changes in the risk parameters of the system. The structure is called DAO, Decentralized Autonomous Organization, and you'll see across many different DeFi platforms. The users will be able to take part in the governance of the structure, which will make it truly democratic and very different from the centralized financial institutions that we know today. Of course, there will always be risk factors of DAOs. Black Swan event in ETH can spiral the price control system of DAI out of control. This happened in March 12th and 13th of this year, when the coronavirus pandemic affected the capital markets in general and leaving ETH to lose 50% of its value. The liquidity event caused network congestion and lack of liquidity, and it couldn't handle all the necessary recapitalization required. Eventually, it was solved, but technical issues such as these can occur. Irrational markets over a long period of time could cause market participants to lose confidence in the stability and the liquidity of the system. Complexity in the system can work against the developers being able to recognize human error or failing to prepare for all the circumstances. It can also drive users away from more simpler systems, such as the centralized stablecoins. And of course, malicious hacking attacks. When there's a vulnerable code in the system, it can lead to hacking of collateral assets. Dysfunctioning DAO is also an issue as these systems are based on network effect and participation. If they all lose interest in supporting the system, it won't be able to function as it should, leading to users' dissatisfaction and leaving the platform. Decentralized exchanges, DEX, as they call it. We now know that crypto exchanges disintermediated a lot of the complex entity that are surrounding centralized exchanges, such as brokers, wholesalers, and settlement agencies. But what decentralized exchanges has done has disintermediated the actual centralized exchanges itself. However, decentralized exchanges has taken out the central authorities that run the crypto exchanges. There's no single controlling entity and everything runs on smart contracts. When the first DEX appeared, it was aggregating all the orders and matching all the orders against each other. Liquidity was a huge problem. However, DEX 2.0, like Uniswap and SushiSwap, with automated market making system, will have an existing liquidity pool that will prevent price slippage. The way they achieve that is by allowing for participants to become liquidity providers in exchange for a fee. Obviously, they need to be compensated for their lost opportunity cost. Token creators can also introduce a new token into the exchange by depositing a liquidity pool of the trading pair. And they certainly got colorful. Decentralized lending. When we simplify the bank's job when issuing a loan, what do? First, they look at the risk of the credit. Then, according to the risk, they size the amount of the loan, the interest rate to change, and also the tenor. In this process, the tenor is the most difficult element. It depends on the incoming amount of cash flow of the borrower and its stability. This is especially important if the loan is a non-recourse loan, basically with no collateral. Even with the collateral, the loan-to-value is usually 75%, and the bank takes a risk with the remaining 25%, so analyzing the borrower's cash flow is essential. Now, how can banks issue a loan? They will need deposits as they work on fractional reserve banking, so they need to pool as many deposits they can from their customers. What decentralized lenders like Compound, Aave, and the likes does is simplifying the lending practice. What they do is take the tenor out of the equation. They stick to collateralized short-term lending so that in practice it is quite similar to what Maker is doing. However, what is different is that they allow for multiple tokens to be collateralized. And the LTV of that will depend on the supply and demand of those tokens. Let me give you an example. Example 1 is you deposit 100 DAI. The LTV of DAI, since it is a stablecoin, it's relatively stable. You get a factor of 90. So for the borrower, they get to borrow up to $90 of tokens of your liking. Example 2 is you deposit $300 worth of ETH. The LTV is 60%, so you get $180. Example 3 is, let's say you want to deposit various tokens for collateral. You post 100 DAI and $300 of ETH. Now combine the example from before and get to borrow $270. Where DeFi gets interesting and complex is when you start jumping between dApps. Let's say you have ETH and you want to trade that ETH, so you get issued DAI. You're trading that DAI, but you want to lever up, so you go on to Compound and borrow it for 15%. Later, you notice that from Aave, you can borrow it for 10%. So you borrow from Aave at 10%, and you repay that Compound loan, and then use that deposit that you get back from Compound, those ETH, and then you deposit that again with Aave to pay back the initial loan, and then you start trading again. Now, sometimes you might even forget that where is the actual loan outstanding? Confusing, right? You still have that 10% that you re-borrowed from Aave. With all these services, you can hop around and find the best rate, and you can lower your cost of capital. Another thing you could do with these platforms is get a savings rate. If you're a token holder, you can deposit your tokens and get a savings rate because the platform will lend it out to a crypto trader who wants to lever up their trade and get an attractive investment. These are just a few platforms I mentioned, but there are asset tokenization platforms, insurance, marketplaces, and many more. People can use all these different dApps all together, which makes DeFi into a money Lego. One dApp stacked on top of another. Many of these platforms have their own utility tokens that can be used for governance, usage, incentive fees, interest, and so on. Compared to 2017 during the ICO craze, the roles of utility tokens and cryptocurrencies are becoming more defined. On the infrastructure level, cryptocurrencies are being used for the service and application, and the utility tokens are being used for usage and incentive fees. There's about $11 billion locked up in DeFi, but before the COVID-19 pandemic hit, it was still under $1 billion. It's such a nascent industry. And then I wonder, in a Black Swan event, will they be able to roll back all these transactions without a centralized authority? So I decided to ask the CEO of Selfkey, Edmund Lowell. And then what if there's some kind of systemic incident happening in the crypto space where these markets crash, these hedge funds can't pay back all their margins, and the whole thing might even just go bust? I mean, is there any collateral from you as a lender to get some of this money back, because they might go lend it off synthetically somewhere else?
Yeah, I mean, it definitely is risky. And I actually, just on the point of regulation, think that it's really on the industry at this point to self-regulate. I think it's on the industry to handle things like identity, things like KYC, AML policies and procedures in a way that's proactive and can anticipate that regulation is going to come. Because as we've seen with other use cases in cryptocurrency, probably fiat on-ramp, off-ramps being the most infamous, there's really a lot of KYC, AML regulations in particular that have come out in the past few years around that.
Self-regulation, AML, KYC, and automated triggers to roll back the transaction seems to be the available methods at this time. But because retail investors are involved, I still do have concerns about the enforceabilities about these transactions. But then again, regulated financial institutions can cause global financial crisis, so it's still yet to be determined. Also, due to the complexity of the service and platforms, I do have a concern whether it be popularized outside of the crypto community. When I first got into Bitcoin, I was really excited that this will be a tool for people with no means to store wealth. There are people living in countries with laissez-faire monetary policies that reduce to poverty because of inflation. There are people who are unbanked, underbanked, with no means of financial services. Bitcoin was a tool to reach out and provide financial inclusion for all. In order for these DeFi projects to become a tool for financial inclusion, simpler explanation of its services need to happen. But as I said with the DeFi industry, the blockchain industry as a whole is such a nascent industry, and it'll become much simpler for regular, ordinary folks to understand. But the bottom line is, blockchain technology will continue to disintermediate the overly complex financial institutions by reducing friction, points of failure, and reducing cost. So therefore, it makes sense for us to keep an eye out on the DeFi industry, as it will pave the way for the future of financial innovation. Thank you very much.